Listen carefully. I am not talking about a routine pullback in silver. I am not talking about another week of volatility that financial media will explain away with a few headlines and a few convenient narratives. I am talking about something much deeper, something that most investors are still failing to recognize because they are focused on price while ignoring the conditions that drive price. You need to understand what is happening. The real question is not whether silver will experience pressure. The real question is whether you understand where that pressure is coming from and why the current environment looks increasingly similar to the early stages of previous liquidity contractions. Most people believe liquidity is simply money. It is not. Liquidity is flexibility. It is the ability of capital to move freely through the system. It is the ability of institutions to finance positions, roll debt, manage risk, and absorb shocks without triggering larger consequences. And right now, that flexibility is beginning to deteriorate. This is not speculation. This is structure. For years, global markets benefited from an environment that rewarded leverage. Debt became cheap. Financing became abundant. Risk appeared manageable. Every time instability emerged, intervention arrived. Every time pressure started building, additional liquidity helped suppress the consequences. That environment created confidence, but it also created dependence. The problem with dependence is that it remains invisible until the support begins to weaken. When a financial system becomes accustomed to abundant liquidity, even modest tightening can create disproportionate effects. Conditions that once appeared stable suddenly become fragile. Positions that once appeared safe suddenly require adjustment. History has proven this again and again. The transition from easy liquidity to constrained liquidity never feels dramatic in the beginning. It starts quietly. It starts beneath the surface. It starts with subtle changes that most people dismiss because they do not yet see obvious consequences. But consequences always arrive eventually. What concerns me today is not a single indicator. It is the combination of pressures developing simultaneously. Debt remains elevated across the global economy. Financing costs are higher than they were during the era of near-zero rates. Governments continue to face expanding fiscal burdens. Corporations are dealing with increased refinancing challenges. Consumers are facing persistent cost pressures. Individually, these factors may seem manageable. Collectively, they create a system that becomes increasingly sensitive to liquidity fluctuations. That sensitivity matters because once a highly leveraged system becomes sensitive, small disruptions begin producing larger reactions. This is where silver enters the conversation. Most investors look at silver through a narrow lens. They focus on industrial demand. They focus on inflation expectations. They focus on supply deficits and mining production. Those factors matter, but they are not the entire story. Silver also exists within a financial system that is driven by leveraged collateral, financing conditions, and capital flows. It is connected to broader market behavior, whether investors acknowledge it or not. And that connection becomes extremely important during periods of tightening liquidity. I want you to think carefully about how financial pressure actually develops. Pressure does not appear all at once. It accumulates. A lender becomes more cautious. A borrower pays a higher financing cost. Position becomes more expensive to maintain. A portfolio manager reduces exposure. An institution reallocates capital. Each decision appears isolated, but together they create momentum, and momentum inside a leveraged system can spread much faster than most participants expect. This is why liquidity events often surprise the majority. The warning signs exist long before the headlines appear. By the time the average investor recognizes the shift, positioning has already begun changing beneath the surface. That is exactly why I believe silver investors need to pay attention right now. Not because a crisis has officially arrived, not because panic is already visible, but because the conditions that typically precede larger adjustments are becoming increasingly difficult to ignore. You are looking at a world where policymakers face growing constraints. They want economic growth. They want financial stability. They want manageable borrowing costs. They want controlled inflation. But achieving all of those objectives simultaneously becomes far more difficult when debt levels remain elevated. Eventually, trade-offs emerge, and when trade-offs emerge, liquidity becomes the critical variable, not headlines, not forecasts, not market narratives, liquidity. Because liquidity determines how much pressure the system can absorb before behavior changes. The majority of investors still assume that stability is the default outcome. I believe that assumption deserves serious scrutiny. The reason is simple. Every cycle reaches a stage where previous solutions become less effective. Additional intervention produces diminishing results. Additional debt creates additional burdens. Additional liquidity creates additional distortions. At first, those distortions remain hidden, then they become visible. And once they become visible, capital begins to react. This is where silver becomes particularly interesting. Silver occupies a unique position between financial asset and monetary asset. That dual identity creates opportunities, but it also creates volatility. During liquidity contraction, silver can experience pressure as leveraged participants reduce exposure. At the same time, silver can attract attention from investors seeking protection from broader instability. Those forces can exist simultaneously, and when they do, price behavior often becomes confusing to those who are only looking at short-term movements. You need to look deeper than that. You need to focus on the structure, because the structure is where the real story exists. What I see today is not a market operating with increasing flexibility. I see a system operating with declining flexibility. I see debt interacting with tighter financial conditions. I see policymakers facing increasingly difficult choices. And I see liquidity becoming more important with every passing month. That does not mean the adjustment will happen tomorrow. It does not mean every asset will respond immediately, but it does mean the environment is changing. And when environments change, investors who recognize the shift early gain an advantage over those who wait for universal confirmation. Most people will continue watching price. Most people will continue waiting for certainty. Most people will continue assuming that if something significant were developing, it would already be obvious. That assumption has been costly throughout financial history, because the biggest transitions rarely begin with obvious signals. They begin with subtle pressures, and those pressures are becoming increasingly difficult to ignore. Now, I want you to take a step back and look beyond silver itself, because this is where most investors make a critical mistake. They isolate individual assets and analyze them independently while ignoring the larger framework that ultimately determines how capital behaves. Markets do not exist in isolation. Silver does not exist in isolation. Every major asset class is connected through the movement of capital, and capital responds first and foremost to liquidity conditions. That is why understanding liquidity is far more important than understanding any single headline. When liquidity expands, mistakes are often rewarded. Risk becomes easier to carry. Poor decisions remain hidden. Excessive leverage appears manageable because financing remains available, and the consequences of bad positioning are delayed. But when liquidity begins to contract, reality returns. That return to reality is rarely comfortable. I want you to think about the debt cycle for a moment. For decades, economic growth has increasingly depended on debt expansion. Governments borrowed more, corporations borrowed more, consumers borrowed more, financial institutions became more dependent on leverage. The system adapted to a world where debt was not merely useful but essential. The problem is that debt always carries a future cost. Eventually, obligations must be serviced. Eventually, financing conditions matter. Eventually, interest expenses begin competing with growth itself. That is the stage many economies are moving toward right now. The challenge is not simply that debt exists. The challenge is that debt has accumulated during an era that may no longer provide the same level of monetary flexibility. This is where the pressure begins, not with collapse, not with panic, with constraint. And constraints change behavior. When institutions face constraints, they become more selective. When lenders become more selective, capital becomes harder to access. When capital becomes harder to access, leverage becomes more dangerous. When leverage becomes more dangerous, forced decisions begin appearing throughout the system. This sequence is remarkably consistent throughout financial history. The details change, the countries change, the assets change, but the underlying mechanics remain surprisingly similar. That is why I pay attention to structural conditions rather than daily narratives. Daily narratives are constantly changing. Structure changes slowly. And when structure changes, consequences follow. What concerns me today is that many investors remain focused on outcomes while ignoring causes. They want to know where silver will trade next month. They want to know what the next headline will be. They want certainty. But certainty is rarely available during major transitions. Recognition is. And recognition matters more because if you recognize the environment correctly, you can understand why volatility is increasing, why capital flows are becoming more important, and why liquidity deserves more attention than almost any other variable. This brings us back to silver. Silver occupies a position that becomes increasingly important during periods of uncertainty. Not because it is immune to pressure, nothing is immune to pressure, but because silver exists at the intersection of several powerful forces. It is an industrial metal, it is a monetary metal, it is a financial asset, and it is also viewed by many investors as a store of value during periods of instability. That combination creates a unique dynamic. Under normal conditions, those characteristics may appear balanced. Under stressed conditions, they can collide. That collision is where volatility emerges. I want you to understand something that many investors fail to appreciate. Volatility is not always evidence of weakness. Sometimes volatility is evidence of transition. Sometimes it reflects competing forces attempting to establish a new equilibrium. One group is selling because they need liquidity. Another group is buying because they seek protection. One group is reducing exposure. Another group is increasing exposure. The market becomes a battlefield between necessity and preservation. And when necessity confronts preservation, price movements often become sharp and unpredictable. This is why I believe many investors are misreading the current environment. They continue evaluating markets through frameworks that were built during years of abundant liquidity. But the environment today is different. Financing costs are different, debt burdens are different, policy flexibility is different, market sensitivity is different, and when the environment changes, assumptions must change as well. The greatest risk during periods of transition is not volatility. The greatest risk is relying on outdated assumptions. History demonstrates this repeatedly. Every major adjustment catches a large percentage of participants unprepared, not because information was unavailable, but because the majority continued assuming that the future would resemble the recent past. That assumption becomes dangerous when structural conditions shift. You need to ask yourself a simple question. What happens when a financial system that is dependent on increasing liquidity begins operating with less of it? The answer is not theoretical. The answer is adjustment. Adjustment in valuations, adjustment in positioning, adjustment in expectations, adjustment in risk tolerance. The process can unfold slowly at first. Then suddenly, that is how financial transitions often develop. They spend months building pressure. Then they release that pressure in a much shorter period of time. Most people focus exclusively on the release. Few people study the buildup. But the buildup is where the real signal exists. And right now, I believe the buildup deserves attention, not because a specific outcome is guaranteed, not because anyone can predict the exact timing, but because the underlying conditions are becoming increasingly difficult to dismiss. You are seeing rising sensitivity throughout the system. You are seeing growing dependence on intervention. You are seeing markets react more aggressively to liquidity-related developments. These are not isolated events. They are connected. And once you begin viewing them through that lens, the picture becomes clearer. What appears random begins looking structured. What appears temporary begins looking systemic. What appears isolated begins looking interconnected. That shift in perspective is important because investors who understand the structure often recognize changes before the broader market does. The majority waits for consensus. The majority waits for confirmation. The majority waits until the adjustment becomes obvious. But obvious adjustments rarely provide the greatest opportunity. By the time everyone sees the shift, much of the repositioning has already occurred. That is why awareness matters. Not panic, not speculation, awareness. Because awareness allows you to evaluate conditions objectively rather than emotionally. And objective evaluation becomes increasingly valuable as liquidity conditions continue tightening. The real question is no longer whether pressure exists. The real question is how that pressure ultimately expresses itself throughout the financial system. And that is exactly what we need to examine next. The next thing you need to understand is that financial systems rarely move from stability to instability in a straight line. Most people imagine major transitions as dramatic events that suddenly appear without warning. That is not how structural change usually unfolds. The process is far more deceptive. Periods of stress are often interrupted by periods of relief. Markets weaken, then recover. Volatility rises, then subsides. Confidence falls, then returns. These temporary improvements create the illusion that underlying problems have been solved when, in reality, they have merely been postponed. That distinction matters because postponement is not resolution. A debt burden does not disappear because markets rally. Liquidity constraints do not disappear because sentiment improves. Structural imbalances do not disappear because participants become temporarily optimistic. The underlying pressures remain. And when those pressures remain unresolved, they continue accumulating beneath the surface. This is why I pay close attention to the difference between appearance and reality. Apis focuses on short-term behavior. Reality focuses on long-term structure. Right now, the appearance of stability still exists in many areas of the financial system, but beneath that appearance, important dynamics are changing. Liquidity is becoming more selective. Capital is becoming more cautious. Risk is becoming more expensive. And these changes are occurring simultaneously. That combination deserves attention because once multiple pressures begin converging, the margin for error becomes smaller. Institutions can tolerate one challenge. They can often tolerate two. But when several pressures begin interacting at the same time, the system becomes increasingly reactive. That reactivity is what concerns me. Not because it guarantees a specific outcome, but because reactive systems tend to amplify mistakes. They amplify uncertainty, they amplify volatility, and they amplify the consequences of poor positioning. This brings us back to silver and why the current environment is so important. Many investors continue viewing silver primarily through the lens of recent performance. They focus on what happened last month. They focus on recent price action. They focus on short-term narratives, but major transitions are rarely driven by recent performance. They are driven by changing conditions, and changing conditions are exactly what we are seeing today. I want you to consider how capital behaves when confidence in financial stability begins to weaken. Capital does not move all at once. It moves gradually at first. Small relocations occur. Defensive positioning increases. Risk exposure decreases. Liquidity preferences change. These movements appear insignificant when viewed individually, but together they create trends. And trends become powerful once they gain momentum. This is especially important in markets that are relatively small compared to global pools of capital. Silver remains a relatively small market when compared to the scale of institutional capital worldwide. That means shifts in allocation can have outsized effects. A modest change in positioning from large participants can create substantial changes in market behavior. Most people underestimate this. They assume that because changes begin quietly, they will remain quiet. History suggests otherwise. History suggests that once capital begins recognizing structural risk, adjustments can accelerate rapidly. And acceleration is what catches the majority by surprise. The reason is simple. Human psychology tends to extrapolate the recent past into the future. When conditions appear stable, people assume stability will continue. When volatility remains low, people assume volatility will remain low. When liquidity appears available, people assume liquidity will remain available. But assumptions built on recent conditions often fail during turning points. That is why awareness of structural change matters so much. You cannot rely exclusively on what has worked during the previous phase. You must evaluate whether the environment itself is evolving, and I believe it is. I believe the financial system is entering a period where liquidity will play a larger role in determining outcomes than many investors currently appreciate. That does not mean every asset will respond in the same way. Quite the opposite. Different assets will respond differently depending on how they interact with tightening conditions. Some assets will experience pressure because they depend heavily on leverage. Others may benefit from increasing demand for protection. Silver occupies an unusual position because it interacts with both dynamics simultaneously. That dual exposure creates uncertainty, but it also creates significance. Because when an asset becomes linked to both financial stress and wealth preservation, investor behavior can change very quickly. The transition often begins before the broader public recognizes what is occurring. Professional capital starts adjusting. Risk managers managers become more cautious, institutions review exposure, portfolio allocations shift, then eventually the narrative changes, then headlines change, then public awareness increases. But by that point, the adjustment process is already underway. This is one of the most important lessons in investing. Recognition typically follows movement. It does not precede it. The majority waits for evidence that everyone can see. But by the time everyone can see it, the opportunity landscape has already changed. That is why I continue returning to the same point. Liquidity matters. Liquidity determines flexibility. Liquidity determines resilience. Liquidity determines how effectively markets absorb pressure, and when liquidity tightens inside a system carrying substantial debt and leverage, consequences eventually emerge. The timing may vary, the sequence may vary, but the underlying principle remains remarkably consistent. Pressure accumulates, behavior changes, positioning adjusts, markets reprice. That process is not emotional, it is mechanical, and mechanical processes continue whether participants are prepared or not. You need to understand that clearly, because many investors are still approaching this environment as if abundant liquidity remains permanently available. I do not believe that assumption deserves confidence. I believe it deserves scrutiny. The world is changing, financial conditions are changing, capital flows are changing, and silver sits directly within that transition, not as the cause of the adjustment, but as one of the areas where the adjustment may become visible. The real question is not whether the system faces pressure. The pressure is already present. The real question is how quickly that pressure transforms into broader recognition, because once recognition spreads, positioning changes, and when positioning changes inside a constrained liquidity environment, market reactions rarely remain gradual, they become decisive.